Hi, everyone. It's great to be here. Thank you so much for the Vesperi team for hosting. My name is Hanna-Stina Sonts, and I work for the intelligence team at Atomico, where my job is to bring data-driven insights for us to have more meaningful conversations with our LPs, our founders, and other investors. So at Atomico, we partner with the most ambitious founders from seed to IPO, and we have a particular focus on Europe. We have offices in Stockholm, Paris, and Berlin, but the core of our business is based in London. We were founded in 2006, and since then we've been lucky enough to partner with more than 100 founders. Some of the names you might recognize include Klarna, Hinge Health, Supercell, and MessageBird. But today I'm here to talk to you about the State of European Tech report, where I'm also co-author. So we started a report 10 years ago because at the time there were a lot of misconceptions around what European tech actually meant. There were still some unhelpful stereotypes and also some lingering overhang from the dot-com bubble. So already back then we had quite a strong data stack, and we wanted to use it to build a data-driven story around what was really happening in Europe. Since then, the report has become the definitive benchmark of European tech. And this year was our 10th year anniversary, so we used it to look back at the last decade, at how far Europe has come, but also to highlight some of the barriers that Europe is still facing to reach its full potential. So you'll hear me refer to the flywheel quite a few times throughout the presentation. The idea is that success breeds success, and in the case of the ecosystem in Europe, we're seeing that the top founders will attract more talent and capital, and together they will build successful companies that will exit, releasing back the talent and the capital to the next success stories. This also has a positive impact on the whole of Europe by increasing GDP, adding more jobs, and also to more societal impacts, such as impact of investing, etc. The flywheel in Europe has been spinning faster and faster over the 10 years. We've been tracking it via some key indicators that we'll dig into shortly. So starting off with talent. Today in Europe, there's more than 3.5 million people working in tech. But 10 years ago, we started at a much lower base. So over that period, we've added 10 million people. And what is important to note is that we're actually growing at a 24% compounded annual growth rate, and that's the same in the US. So actually, the talent base is growing as quickly in Europe as it is in the US. 10 years ago, we had to really tell people how exciting Europe is and convince them to come and have a look. But today, the opposite is happening. There are more investors than ever investing in European tech. And looking specifically at US-based investors, today there are more than 1,000 unique US VC funds investing in European tech. That's a 2.5 increase over the decade. This improvement has also been seen throughout the total funding numbers. In the last year, $426 billion were invested in European tech. That's up from 43 the decade before, so more than a 10x increase. Looking ahead at what 2025 might bring will be difficult, but if we just look at the first few months of the year, we think we might land in flat when looking at the 24 and 23 numbers. However, now that the liquidity and exit markets is starting to improve, there might be an acceleration throughout the summer, so we might even end up the year much further up than this. Looking at the valuation levels, we're seeing that there's quite a big difference between the early stages and the growth stages. So when the public valuation started to improve in early 2023, we saw that play out also in the growth stage companies. At the early stage, companies are much further removed from becoming public, so those companies have gone through a more steady increase in their valuations, whilst at the Series A and Series B levels, they saw a decline and then a further acceleration in 24. What is interesting to note is the steep differences between the European and US companies. So at the early stages of seed, European companies are at an average of 58% discount compared to their US peers, and the same big difference is seen at the Series A and Series B stages. The same plays out at the average round sizes, but what we're noticing is that AI is having an effect not at just how products are being built, but also how companies are being built. The best founders are able to leverage AI technologies to their advantage, and they're able to build bigger products and get more traction with leaner teams and faster than ever. This means that the top founders are able to raise even bigger conviction-sized tickets and able to scale fast. The same trend is playing out in the US and Europe, where the average round sizes have been increasing. However, again, Europe is still at a discount where you compare to the US. And why does it matter? It's because if you look at the companies and how many of them end up becoming unicorns, then Europe is actually the same level of efficient as the US. So when you look at the amount of companies who reach unicorn status, then the percentage of them is the same in Europe and US when you normalize for the total amount of capital raised. So this means that what is different is that the scale of investment Europe is receiving is much less, but actually Europe's ability to create billion-dollar outcomes from that money is the same when you look at the US. And how to quantify the scale? Then we've looked at seed stage, how many companies are able to then go on and raise a 15 million round. In the US, it's 8% of companies, but in Europe, it's only half, it's 4%. So this means that the same companies in Europe don't get the same shot at target at expanding globally and gaining new companies, clients, as companies do in the US. And Europe has the talent to build those next companies. If you look at how many founders start companies per year, then we see that in Europe, becoming an entrepreneur is as attractive as ever. Last year, we estimate it was 16,000 new founders who started a company in Europe, compared to 14,000 in the US. And what is even more interesting is that the share of serial founders is growing in Europe. So serial founders are founders that we define to have more than 2 prior companies that they founded, which means that they're able to share more mentorship back to the ecosystem, and they bring valuable experience to their new companies. 10 years ago, this was at 6% in Europe, and today it's grown to 9%. We have demonstrated essential repeatability in Europe, where early success stories have reached new levels and exited, giving the money back to the next generation of companies, therefore oiling the flywheel. Over the last decade in Europe, there's been $1 trillion in total exit value generated from from all companies, and 39% of that was from VC-backed companies in specific. So for example, when you think about 10 years ago, you couldn't have imagined that ARM ends up with 140+ billion market cap, or that Wise and Adyen go on to have blockbuster listings. The scale of outcomes in Europe has become extraordinary. However, we can't ignore that the last few years have been really difficult when it comes to distributions and exits. So for the State of European Tech Report, every year we run a survey where in this question we asked LPs what is stopping more LPs from starting to invest in European tech. And the main reason that they state, and a third of the respondents quoted, was the lack of liquidity and distributions. The same trend is playing out in the US, and if you look at the amount of billion-plus exits, both in the US and Europe, you can now see that 2021 was really an exceptional year, and since then, the numbers have come down and now stabilized. Actually, 2024 was the worst year in a decade, and Europe only saw 2 billion-plus exits compared to 10 the year before. However, we're positive. The Liberation Day a few weeks ago did turn the market back into turmoil, with a few companies postponing their exits even further. But now we see that the markets again have stabilized and are up compared to then. And there's still more positive signs of momentum. So even when you think about the last few weeks, there were huge transactions either announced or gone to the market. Siemens announced that they're going to make a multi-billion acquisition, and Hinge Health and eToro both had their successful IPOs at multi-billion-dollar valuations as well. At the same time, there's also alternative exit routes available. We're seeing that the secondaries volumes are growing year over year, and also the discounts are decreasing, meaning that valuations are going up again. So overall, exit routes are improving as well as diversifying. And liquidity and exits are super important when we think about the flywheel, because that capital then can then go back into the ecosystem and fuel the next big ideas. At Atomico, we're constantly mining our data for the next clusters of innovative ideas and looking at where top founders are building. If you look at what's happening in Europe, then the AI theme is overarching, but we can drill into what are the more smaller pockets driving that growth. And we can see that AI agents, AI-powered real estate, or other vertical-specific solutions are really driving that growth in AI. Looking further into the data on where companies are building, we're also seeing that Europe is putting a lot of its capital into solutions that have the potential to fix the world's biggest problems. 21% of all capital raised in 24 in Europe went to sustainability solutions. That's double the rate of the US, where the same percentage stood at 11%. And looking specifically at the very early stages of investments, at the sub-5 million rounds, we're seeing that there's more deep tech areas that are getting interest from investors. So for example, carbon management, renewable energy solutions, and new materials were some of the top themes that investors in Europe were investing in last year. Overall, the breadth of opportunity in Europe is really extraordinary. However, we acknowledge that we're at a 30-year, the US is at a 30-year advantage when you compare it to us. But what is less talked about is how quickly Europe is actually gaining ground. So when you look at the total enterprise value created in this decade by VC-backed companies, Europe accounts for 17% of it. That's a huge increase from the 1% a few decades ago. So we're seeing that Europe is actually not only keeping pace, but it's also increasing its share of the pie. We think that the next era of global innovation is being written right now, and Europe has the potential to become a leader when it builds its own solutions at its own terms, moves fast, and supports the best founders with bold ambition. Thank you so much for joining me today. I hope you found this insightful. I did want to add that on top of the report that we write every year, we also made a documentary this year, which you can see a little bit in the background. It talks about the success stories of European tech and how we should all be inspired by it. And yeah, please go and explore on www.stateofeuropeantech.com. Thank you. I think we have a minute for Q&A if you have any questions as well. Yes?
How do we close the gap on the growth? Thank you for the presentation. How do we close the gap at the growth stage in Europe? Because we have a lot of LPs like pension funds and insurance that are a little bit conservative into deploying at the growth stage. So I guess that's a little bit where we kind of lag behind.
Yeah, no, that's a great question. So last year we estimated the gap to be 350 billion when you look at the investment activity over the last year. And we made some assumptions about if the investment funds from pensions and insurers would increase their allocation, then how much of this we could bridge, and it really only scratches the surface. Like, it definitely would be helpful, but in the end, they're not going to be like a magic solution. I think in reality, we need a lot more local investments, as well as more external investors. So Europe is already now seeing a lot more US funds coming in and investing, but also funds from Asia. And in the end of the day, the more investors we have in Europe, the better for the ecosystem, because locally in Europe, most VCs are still able to support early stages. and the amount of funds that also cater for growth is still not quite there yet. Thank you.
So that I always was concerned that, mediocre or B+ founders are obviously staying, and occasionally A+, but the valuations have to normalize, don't they, for this to really shift?
So to recap then, why are valuations lower in Europe versus the US?
A lot of my friends in Europe, the best founders, they come to the US because the valuations are so much lower in Europe, and until that problem is fixed, I wonder.
No, definitely. But at the same time, I think it's a quite difficult trade-off for companies, because if your client base is in Europe, then it's attractive to stay there, to start your company from there and scale later. Secondly, Europe has a lot of talent, which is cheaper than the US. So you can probably scale further with less money as well. What is at the moment tricky is that even the companies who choose to start their companies in Europe and scale end up exiting in the US. So there's very little IPO activity in Europe, and basically all the top companies are going to the US. The European Commission is trying to come up with a solution there. Let's see. But I think the top founders, to be honest, I don't think it makes a huge difference where they start their business. And in the end, it's more the big outcome that if you want to become the biggest leader, you still need to scale globally. And likely you're going to exit in the US, in which case the valuations you can get are similar, or it doesn't matter where you're from. Nice. Well, thank you so much.